This Bitcoin YouTuber has been warning investors for years. Get to 1 Bitcoin while you can.
Get to 1 Bitcoin.
But almost nobody listened. His name is British HODL, and Bitcoin's 50% crash just proved he was right. While most people panicked, the biggest buyers on the planet did the opposite. The math he warned about, it's now undeniable, and the window to own even a fraction of a Bitcoin is closing. I'm David. I spent years at the biggest Bitcoin security company on earth, and I help professionals and retirees grow their wealth with Bitcoin. When I ran the numbers on British HODL's thesis and what institutions did during this crash, I found something every serious investor needs to see. 3 things: the supply math that proves his thesis, why this crash didn't break his case but validated it, and what institutional money is quietly doing that confirms the window he warned about is closing. British HODL's core argument is simple. There will only ever be 21 million Bitcoin, and the number of people who want one is growing much faster than the supply. Eventually, owning a whole Bitcoin won't be a choice you make, it'll be a privilege you can't afford. Most people hear that and think, sure, 21 million is the cap, but that's still a lot of Bitcoin, so what's the rush? But here's the problem. 21 million is not the number that matters. Think of Bitcoin like a city with a fixed number of houses. 21 million. Enough for a medium-sized country, right? But millions of houses are abandoned. The keys are gone. The owners left. The city owns millions more for planned infrastructure. They'll never be sold. And now corporations are buying entire blocks, taking them off the market permanently. But that's Bitcoin. Let me walk you through the supply stack. How much Bitcoin is actually available? Start with the 21 million cap. About 20 million have already been mined. That's 95%. But mined doesn't mean available. 3 to 4 million are gone forever. Lost keys, destroyed hard drives, deceased owners. Add Satoshi Nakamoto, Bitcoin's creator. 1.1 million coins that haven't moved in over 15 years. That's 4 to 5 million Bitcoin permanently out of circulation. Before we even get to the institutions, the real supply is 15 to 16 million, not 21. Now let's discuss who's holding the rest. Spot Bitcoin ETFs, BlackRock, Fidelity, and others hold 1.3 million. IBIT alone, 770,000. Strategy holds over 730,000 Bitcoin. They've purchased for over 100 weeks straight. Through the crash, through the panic, every single week. The United States government holds over 200,000 Bitcoin as a strategic Bitcoin reserve. Other governments and corporate treasuries, the UK, El Salvador, Marathon, Tether, and dozens more collectively hold hundreds of thousands more. Add all of that up, and the Bitcoin that's realistically available in private hands, not locked in institutions, not lost, is roughly 14 million coins. That's the honest number. Now here's where British HODL's argument becomes mathematically undeniable. There are 60 million millionaires in the world, 14 million available coins. But those 60 million people control most of the world's investable capital. And capital doesn't buy one of something, it allocates percentages. So 5% of a $10 million portfolio is 7 coins. When wealth allocates, even small percentages create demand that dwarfs the available supply. The math isn't 60 million people wanting 1 coin each. It's trillions in capital chasing 14 million coins. Back to the city example. 60 million wealthy buyers trying to purchase 14 million houses. And the wealthy don't buy one house. They buy blocks. That's the supply math. Once you see it, you can't unsee it. Bitcoin hit $126,000 last October. Right now, it's trading around 70,000. That's a 45% decline. And if you saw that and thought, I knew it, British HODL was wrong, I understand that reaction. But it's the wrong one. Think about beachfront real estate. There's only so much coastline. So when a recession hits, early investors may sell. They've made their money. They're done. Prices drop, but the beach didn't get bigger. The scarcity didn't change. The land just got redistributed to new buyers who saw the value. And that's what happened to Bitcoin. Two forces hit at the same time. Long-term Bitcoin holders sold over 1 million Bitcoin during this cycle. People who bought at $100, $1,000, $10,000 watched it hit six figures and took profits. And through the ETFs, Bitcoin now sits in the same portfolios as tech stocks. So when markets got de-risked, Bitcoin got sold alongside everything else. None of that changed the supply math. Not a single extra Bitcoin was created. The lost coins are still lost. Satoshi's coins are still dormant. The treasury companies are still buying more. The supply just got redistributed from early holders into institutions. And they aren't selling. Van Eck called it statistical stress, not structural failure. Bitcoin is trading at extreme deviation from its long-term trend, in the same range as COVID and FTX, two of the biggest buying opportunities in Bitcoin's history. The crash didn't break the thesis, it made it tighter. The supply math British HODL warned about when Bitcoin was $26,000 is more extreme today than it's ever been, except the price is 45% off its high. The window to get to 1 Bitcoin cracked back open. The question is for how long? Okay, you just heard two massive arguments for Bitcoin, the supply math and the crash validation. But here you are listening to a guy with a YouTube channel. So why would you trust a Bitcoin influencer over your financial advisor? Here's why. When British HODL first posted his thesis, he was talking to regular people. People who might scrape together the money to buy one coin. Most didn't listen, but someone did. The institutions. Bank of America unlocked $3.5 trillion in advisor capital to recommend Bitcoin to clients. Vanguard, the company that publicly refused to touch it, reversed course for 8 million clients. The number of institutional holders of Bitcoin ETFs went from 61 to over 3,300 in 11 months. These institutions didn't watch British HODL's video and rush out to buy. They ran their own analysis, built their own models, looked at the supply, the demand, and they arrived at the exact same conclusion, independently. When the most sophisticated financial institutions on the planet independently confirm the same thesis, that's not one person's opinion anymore, that's a structural shift. British HODL was early. The institutions are confirming. And they're not buying slowly. They're accelerating. The window he warned about isn't closing someday, it's closing now. And the crash just gave you one more chance to act before they finish accumulating what's left. If you want a complete step-by-step framework for buying, securing, and holding Bitcoin, I built the Bitcoin Blueprint. Link below this video. And subscribe for more weekly Bitcoin analysis. Now, what does this actually mean for your wealth if you act on it now? I ran the numbers and I break it down in this video here.